Okay. Well, President Trump holding firm on his August 1st deadline for tariffs to kick in, saying today on Truth Social, quote, no extensions will be granted. Despite the threat of tariffs on everything from semis to pharmaceuticals to copper, volatility remained low. Stocks were fairly muted. Are investors starting to believe tariffs won't have a meaningful impact on the economy? Well, joining us now is Afsaneh Beschloss, founder and CEO of RockCreek Group and former Carlyle Group partner. She is also the former treasurer and CIO of the World Bank, also a board member of the Council on Foreign Relations. And Afsaneh, it's great to have you back on the show. Welcome.
Great to be with you, Morgan. Nice to see you.
Let's start right there, because not all tariffs are created equal. And you do see copper trade at a record high today, perhaps because that's seen as a much stickier tariff that maybe potentially won't go away. How do you navigate this as an investor, and how are you assessing what this means for the economy?
So tariffs in and of themselves are not necessarily a bad thing. They can be helpful in making trade more equitable, especially when there's unfair trade practices by some countries. I think the bigger issue is the shocking way that we're communicating tariff changes and some of the drama around it. So 50% tariffs around copper probably is not a reasonable number, but also the market is, as you said, treating it carefully. The big question will not necessarily be what's happening to copper prices for obvious reasons that we saw, but what is going to happen, for example, to markets like Chile, like Mexico, like Canada, that are copper exporters to the U.S. The other number that the president did throw out today was maybe 100% tariff on pharmaceuticals, not immediately, but down the line. That would be potentially disastrous for every person because we need those pharmaceuticals, and it takes those companies a very long time to produce them here in the U.S. For most companies, they need much more certainty about tariffs, about other policies like permitting and regulation to move into the U.S. and to start producing in the U.S.
And we've heard this about the uncertainty from CEOs. It's certainly going to be something that gets watched as earnings season gets underway as well. How is all of this spurring investor shifts? We're seeing a lot of money move into international markets, and we're seeing outperformance in international markets. We're seeing a lot of volatility across a number of asset classes. How is trade dynamics and the policy dynamics that we're talking about contributing to it?
So, Morgan, basically, investors have been coming into the U.S. to the point that U.S. equities are more than 2/3 of the total world equity index. So that has happened, for example, over the last 20 years, but in the last 10 years, they went up about 10%. What does that mean? It's that investors think we are U.S. is a safe haven. It means that U.S. has higher growth in its economy, innovation, and higher returns. That's why they come here. So as the safe haven question becomes one that people are dealing with and grappling with, as potential innovation becomes a question that people are dealing with, will there be continued innovation if we're cutting back on certain kinds of research? And so all of those are impacting investors in looking at diversified markets. Every investment committee I'm part of or attend, or our clients at RockCreek, are having these kinds of conversations around the table. Should we look outside of the U.S., how much, and should we be hedging our US dollar holdings?
So, Afsaneh, good to see you, first of all. It's been a little while.
Absolutely.
How do you balance your portfolio against the idea that a muscular, newly transactional United States is going to bend the world to its will? What are the countries, regions, indices that benefit if this approach doesn't stick?
So, John, I think what is happening is in some cases, people are continuing to buy U.S. equities in certain sectors. They're excited, let's say, about AI in the U.S. So they will continue to buy stocks around data centers, around chips, around other areas that are U.S.-based securities. However, what they might be doing at the same time, a number of particularly larger institutional investors are hedging their activities by putting on large swaps and reducing their overweight to U.S. dollar FX holdings. So they're using swaps as a way to reduce their exposure to the U.S. The other way investors are looking at, this is something that used to happen like 20 years ago. When investors invested into European or Japanese markets, they wanted to have it hedged back into U.S. dollars.
Okay.
They're doing exactly the opposite. If they're invested in in European securities or Japanese securities now, they're trying to not be hedged into the US dollars and stay in the local currencies.